I look at this market today, and I think the only thing that makes this price action make any sense is if you think a complete dismissal of the trade war and tariffs are all going away tomorrow.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots, and I am joined as always by the brain trust himself, Mr. Chase Taylor. Chase, I was doing some managerial type tasks, so I didn't catch the close. Why don't we start here with a little rundown on the indexes for the day? Let us know where you finished up.
So we're closing just here as we speak, and S&P closing at up 0.58. Q's up 0.64, small caps up 0.58 as well. Also, equal weight up 0.58. That's today's brought to you by 0.58. Oh, Mag 7 up 0.58. Can't make this up.
That's really bizarre.
I never think I've ever seen that before.
No,
it feels like a what was the show, like Elmo and all that. It feels like I'm on that right now.
Yeah.
All World ex-US was up 0.19. Notable today, oil down about 2.8%. That was pretty ugly, and it started to build a decent little bounce, and then that kind of broke today. Gold down 0.56, silver up 0.36, Bitcoin up about 0.5%, dollar up 0.3. It's like dollars is kind of going back and forth in a small range near the lows now, and then yields down a good bit, down 3 on the front end and 4 on the 10-year, and we now have VIX futures back at 23.3, so still obviously above 20, but that's has muted itself a good bit of late, down 1.6% on the day.
I got a good. So for those of you that don't know, we have our weekly investment call here in Bulwark, where we have our analysts and traders and different PMs on the call. There's about 6 of us, I think, every Tuesday. And the thing that and we didn't talk about it. Our other PM that runs our momentum portfolio, he lives in London. So he and I haven't a chance to talk about it, but he gets on there and we always ask him first, hey, you're the one that's not here. Give us your rundown. And he said something right out of the gate that really cracked me up, because we had just been talking about it before he logged on. And he goes, the only comp I've got to this market is it really reminds me of the January before COVID. And I just started dying laughing, because I was like, and it's not I think one of the things that makes us a good group is that very seldom do we all have the same takes. We all come at it from different angles, which I have found extraordinarily helpful.
100%.
Very seldom do we have the same read on things like that. And his argument was very similar to what you and I were saying, which is it's just when you grow up around or when you spend a substantial amount of time around markets, you're so used to the breathing, living dynamic of them and their ability to price in all available information all of a sudden. And watching this market get worse and worse at that gradually over time. And perhaps it's not worse at it. I mean, that's certainly my perception. Maybe it's just that I don't know. Maybe there's just a lot more elasticity. I don't know. You hate to draw conclusions in this game and just say, hey, that's what it is, right? You got to keep an open mind to other things. But that being said, though, we've just seen so many of these situations where, it wasn't that long ago, you and I were talking about how we need to kind of steel ourselves against looking for confirmation from markets, because that confirmation comes usually much later and in a much more delayed fashion than it used to. And that's probably for a whole host of reasons. But it is bizarre to sit there and watch a market where every single day in the current environment, it is getting worse, right? Conditions are getting worse. and to watch that market attempting to rally from valuations of this and bouncing a significant bit off the, off that pullback.
Yeah, about 15% off the lows now for the market.
And a market off 15 to 20% year to date with this backdrop is not a cheap market, let alone pushing higher. And it's really bizarre. You just get the feeling that the rug pull is going to come any day. The other thing that concerns me, and this is yours, and you feel free to elaborate on it because you were the one that brought up this idea. And the more I thought about it, the more it made sense. Really feels to me like the market's bidding against itself here. And I think that everybody can acknowledge, and I'm not saying that I'm in favor of this, I'm against it or whatever, just looking at the setup for what it is. If you're going to get it's the way it appears to me at the time anyway, if you're going to get some type of, because the only thing that really makes sense in this market, and again, I don't think you've got an economic backdrop that supports this market regardless of what's going on in the trade wars, but the only thing that I look at this market today, and I think the only thing that makes this price action make any sense is if you think a complete dismissal of the trade war and tariffs are all going away tomorrow or very soon, right? If you think that's on the table, then I think you can make an argument that you can rally from here.
Yeah, 100%. And
right.
I think that part's important because you could argue, if there was no trade war, if that never started, that stocks might be at 6,500 right now. We may be on our way to another 30, 40% year. The markets were euphoric in November and December. Maybe that just kept going and you just went full 1998, the whole 9 yards. So obviously we did get the trade war. You pulled back 20% before you bounced again. But let's say tomorrow, a total ceasefire with China, like, hey, huge breakthrough. The tariffs are off. While we discuss this, we think we'll have a deal in 6 months. That's an area where, does that mean we go straight to like 6,500? Of course not. But does that mean we might go to 6,100, a new all-time high? Sure. I think that this is the hardest part is like, it's obvious like that what's happening today is, taking bites out of, it's like termites getting into, the structure here of the economy, of the cycle. And none of us know where that point is, that point of no return, where it's like, okay, we've reached the X date where it doesn't matter what you do now. You're having a recession. We're going to eat it on this for 6 months, right?
Yeah, where I'd say that we're still in the gray area where
I know, yeah, exactly. So if that like, hey, trade war, good news, like we're all going to sit down and sing Kumbaya together, comes out tomorrow, I'm like, we probably dodged it. But if it comes out in like a month, I don't know. Like,
well, here's the issue. Like, and this is a point you brought up, and again, the more I kind of roll this around in my brain, the more it makes sense, and I think it's a problem that people aren't really paying attention to. If you watch the long end, right, 30-year treasuries, 20 and 30-year treasuries, and you watch the market, there is a very strong correlation between how it's doing, how both things are doing, and the rhetoric coming out of the White House. It appears very clear to me that as the long end settles down and the market continues to recover, that is stealing their position. Now, 100%. Again, I want to reinforce, we are not having a discussion about whether the tariff approach is the correct approach. We're not having a discussion or a debate about whether they should be tariffing or not tariffing. And this is the really important part where you have to remember this in this game, right? Keep your investments and your politics separate. Okay. And if you don't, you will. You'll learn the hard way or the easy way, right?
No question.
Right. And this is about us just trying to get it right, trying to push politics aside.
And that goes both ways. Like, yeah, if you love Trump and he's never done anything wrong, obviously you can get yourself in trouble here because tariffs will hurt the economy. But at the same time, if you just hate Trump and then so you're already starting to see this where I think if they did a big ceasefire with China, which honestly was what matters here, like the rest we'll get bilateral stuff with all the smaller countries and that'll largely be fine. But when it comes to China, like if he pulls them all back, you're going to see a lot of people that hate Trump get mad and be like, no, why are you going easy on him? Like, whoa. Like you can't be like super anti-trade war and then get mad when they pull back from the trade war because they realize that it is hurting. Right. And I think that will happen. So there would be people that are probably super short that won't cover their shorts on a day where, there's a ceasefire. Because to me, if they announce hey, we're going to take 3 months to work this thing out, tariffs are 20% or whatever, then the right move is to pull hedges and buy everything not nailed down, ride it for at least a few weeks. And a lot of those, ideologues won't do that, right?
No, they can't. And guys, like, I mean, I have been one that believed that a quote unquote trade war with China was inevitable, meaning, I kind of felt like you either just gave them the keys to the house and moved, or you stood and had this confrontation. I have disagreements I would have rolled it out differently. I think I've said that before. But again, I'm just saying all that because I don't want you guys to get caught up and be like, oh, these guys really don't like Trump, or they're really pro-Trump, or whatever. Look, I can guarantee you this. Chase and I don't see Trump the same way either. But
we can view the investing part.
Yeah, very similar.
Usually,
yeah. And that's what's important here. My whole thing is, if you get a rollback, I just don't see any posture, everything we know about China. I just don't see them rolling over. I think that is the least likely of outcomes for a whole variety of reasons. And it's really hard for me to see Trump softening his stance until the market's getting hammered.
Yeah, it's like we've created a weird feedback loop.
Yeah,
and it reminds me of the Fed when they got caught in that, they start talking dovish and everything gets better, and then that makes inflation heat back up, and then they have to get hawkish, and then data rolls over, and then they have to turn around and get dovish. Like, they got stuck in that like switching, and I feel like we're getting there. And to your point, like, I could take the chart of S&P and 10-year yield, and then put daily what they're saying, like plot it, and it would just correlate completely to markets like this, we can get tough again, or like, ooh, market doesn't like this, we better back down. But then you get caught in a loop where now you've made yourself a slave to the market, and the market is a slave to you. And then, like, the thing that got you the bounce is the thing that you're going to end up, bringing back on yourself.
Yeah. And that's why I said it feels like the market's bidding against itself here.
Yeah. Until like that posture changes from, honestly, both countries, like you that is where you're at. Yeah. And you could probably, to an extent, say the same for China.
And Besson said it. Like, listen, people need to hear. And I like Besson. I really do. This is not, again, not a critique, but it was earlier today. Didn't he say, hey, retail's the one buying stocks right now. Retail gets what we're trying to do. Institutions don't. Hey, guys, let me just give you a tip here. If this is the one time that retail sniffs out a buying opportunity and institutions completely miss it, that'll be the first time that ever happened. Okay. Because here's what you usually call that. It's called the top.
and they're usually called dumb money, and for a reason. Yes.
And the other thing too is you've got to look at, and I know if you want to load up on US stocks here, that may end up being the right decision. But I think the thing that you got to cop to is that, at the very least, everything considered, it is an indefensible position to take. Meaning, if you're long risk assets, the U.S. ain't the play.
And every day that goes by, because of like those termites we were talking about, it's a little bit less the play, I think.
Yeah, no, there's unquestionably. And the biggest reason is, again, I'll go back to valuations, right? There's so many things ex-US that sure could get caught up on a little bit of the trade. Sure. They could get hurt a little bit too. But when I'm buying things that are trading at 0.8 times net asset value that are paying me 7% to hold them, and that have very stable, non-volatile businesses,
and if they go down much, that 7% turns into 8, 9, 10.
Right. Yeah. You buy some more and increase your yield. You know what I mean? And especially you're trading it below net asset value. So all you're doing is just, you're just getting deeper in the money.
Right.
And that's the problem with so many of these other US assets. Where's the bottom for Apple? Where's the bottom for Costco? It's a hell of a lot lower than where they currently are. That's where it is. You got stuff priced at levels that doesn't make any sense. And that's the thing I think that is going to be, just somewhat indefensible for this market, because I just, like you and I have talked about, if Trump announces, like, let's say he came out today and said, okay, tariff war is over and all that kind of stuff. I know what retail is going to do. It's going to buy the living hell out of QQQ. You know what I'm going to be buying? K-Web, man. I want Chinese tech. Yeah, I think Chinese tech will probably rally 2-1 to US. Just go look at the valuations. Go look how beat down it is, right? Now that I've said that, that's probably that'll probably end up being the worst play.
I just thought about the GIF. Why not both?
Yeah, and you can. But I'm just saying, like, if that's the other thing is, I think the cat's out of the bag as far as international goes. I like I said, I don't think it's just going to be international going up and US just plummeting, but I do think that the asset, like if you got that game on signal from the White House, I honestly think that the asset mix that got bought hard would be different than it's been in period. Like, meaning I already believe that the cat is somewhat out of the bag. You know what I mean? I think the whole US only focus of international investors, I mean, this is still the US market, clearly, but I don't think you can put that toothpaste back in the tube. I think people have become aware, holy smokes, guys. If we get this trade deal, I mean, what do you want to do, right? You get a situation like this, and if you know the situation's going to resolve itself, typically you want to own the thing that's gotten beaten up the worst from that situation, right? Well, turn around, look at U.S. markets trading at 28 times trailing 12 earnings, or 27, wherever we're currently at right now, and that isn't even close to it. You know, like I said, I look at Chinese stocks. I think they get so with fiscal and everything they got going. I mean, that looks like where you want to be. I think you make an argument for parts of Europe, especially those that are the most closely aligned to Germany, you know, chasing that fiscal response like you and I have talked about.
Yeah.
But man, I mean, other than just short-term trade movements, it just feels like dead money here.
Yeah. And another thing we've talked about too, like if you think about where we're looking like fiscally right now. So the deficit, I mean, we're, almost May here. The deficit's tracking higher than it was last year. So this notion that the fiscal thing is going to get all like in order, kind of obvious at this point, kind of obviously not the case, which keeps alive this feedback loop where big deficits, big debt, big interest expense starts to become like a way to, a bit of its own problematic loop, where you could argue in some ways, like the only way to like start defending the dollar would be to raise rates. Now we don't need to defend it at 99, right? But at some point you might start to feel a little queasy about where it goes. And in that kind of world where we've lived in a world where we've had the luxury of just looking at the difference between countries' interest rates and been like, oh, we'll buy that currency then. But this starts to get into a different situation where we do start to have some emerging market characteristics in our currency. And in that world, you look at a Germany who's 60% of debt to GDP. My buddy Matt Casey mentioned something today that like in Sweden is like 33% debt to GDP. So I'm like, yeah, I kind of want some of that currency. I kind of want some of those stocks, like buying some of these wildly under-levered places as a way to hide from some of that starts to make more sense as well. Like there's the only game in town part is I think you can have a big pushback and go to even bigger multiples in the US. But to your point, like our big pension fund managers and sovereign wealth fund managers and everything, are they going to keep doing what they've been doing on US? No. Is it? But one thing I will say, and I'll stop rambling. But if we had a no kidding just ceasefire on the trade war, that would mean that our trade deficit isn't going to come in, which means our capital account surplus going to stay high. So they're going to buy something in the U.S. And because of what we're doing with the currency and the debt, and why would you want to own treasuries? Honestly, like maybe these countries do just pile back into equities because that's the smartest place to be if people are going to kind of, devalue and print and stuff. Anyways.
There's another dynamic here. You brought it up, and it's one that I haven't completely fleshed out yet. Is that dollar dynamic playing in here? Because if the green light gets turned back on against, regarding the all U.S. portfolio, right? If that were to gain traction again, I don't think that can happen again without the dollar moving substantially higher. Right? Meaning, like, if you go back and look at 0809, right? for all the dollar is collapsing people out there. Yeah, the DXY, I want to say at the end of 09, like it's 77, something like that.
Well, look,
It was in the 70s.
yeah,
Okay. So you're at 99 today. Now, remember, we've talked a lot about one of the things that's forgotten about 08, 09, except by me, because I was managing money at the time, was everybody talks about the U.S. bounce back from that. Emerging markets bounce back way harder, way faster. Yeah. I mean, they came
all the way through 07.
Yeah, they came ripping back. But you had that dollar index down at 77, right? Like, meaning I almost feel like the only way you continue on with this only U.S. portfolio is if something bad happens in the world, sending the dollar higher, and everybody's got to go back into the dollar only game. It really feels to me like that. If there is any way to get the proverbial toothpaste back in the tube, if you will, on the only U.S. portfolio, I think it would take a sharp move higher on the dollar. And I just don't see that.
There's no point in that, because then you're just right back into the situation that led to us being like, man, we got to we got to change the system. You're like, you're just right back to that giant trade deficit. Everyone putting all their money here, like dollar being too expensive to be able to effectively export anything.
Yep.
You're just right back to where you started. And then what was the point of the last 3 months?
Yep. No, I know. And, it's weird to say this, but yeah, you're just left in a position where you're like, hey, is this market going to keep playing reflexive games, or is it going to start reflecting actual, value, and things of that nature? Again, it seems like we've started that process, but you look at the stuff that was rallying the hardest, this is not a sober market still. Clearly not a market that's been sobered up. Another one, we got some more data out today. The other one that I think is, again, put it in the list of things the market is ignoring. We're seeing, and again, if you listen to the show for a long time, you cannot take any one data print too seriously, right? But if you're looking at manufacturing surveys and you get one really nasty print, regardless of which manufacturing region or locale it is, you have to take it with a grain of salt. There's always one off. When you see all of them coming back the way they're coming back, and to put it into context, we're seeing the worst readings that we've seen out of these things, only comparable readings being in the COVID shutdown and at the bottom of the 08, 09
There's a bunch of that stuff.
Yeah, bunch of that stuff. So, and again, that's why it's so puzzling to look at this market, think that, it's just completely looking past all of that.
Yeah.
Give us a little more insight into how bad those data prints were.
So I'll rip through the things we got today. So first, the trade deficit came out and it was huge, way bigger than expected. So that was a big hit to the Q1 GDP estimates, which are now the Atlanta Fed has it at negative 1.5, and like if you looked on Kalshi this morning, it was positive 0.5, and last I saw you were negative 0.4. So you've shaved 1% on that. So we're probably gonna have a negative print for GDP, and that comes out later this week. Texas is a service sector survey came out. So yesterday they had their manufacturing, today their services bad. Like speaking of the only worse, COVID, GFC, the employment metric in that's what it showed. The conference board's data came out. One of the big ones there is they have a thing that's like, wait, what do you think the employment situation will be in 6 months? And if you map that onto the unemployment rate, like it's a pretty tight fit. Like when that thing explodes higher, so will the unemployment rate, and it's absolutely exploding higher. And probably COVID and GFC levels, right? Same thing. But the confidence, the expectations, all that stuff. The expectations is below the lowest it got in COVID. So it's even worse than the COVID bottom. And then the confidence level is basically about to take that out. So there's just so much stuff like this that, It's one thing to say like, soft data, like, well, I'll pay attention when the hard data follows. But when the soft data is catastrophic.
And when it's all the same, right? Like
Yeah.
it's one thing and listeners can just take this from me as a piece of advice, but I've just seen it over and over in my career. I've always been very careful with any of these surveys because honestly, what the surveys have been to me most of the time is they are fodder to frame whatever framework or to support whatever framework I currently have, right? It's almost like I can go through the data, find one of the Fed reports that backs up my point of view.
That's why to me, like you go through it with both lenses.
Yep.
Like if I was a giant bull, pick out everything I would find. If I was a giant bear, pick out everything I'd find and then stack up those numbers. Like which one is it? Because sometimes it's 50-50 and I'll just ignore it at that point.
Yep.
But then there's times where I might be bearish, but there's enough both stuff in there where I'm like, well, okay, never mind.
Yep.
But then every once in a while you have moments like now where it's like, oh, this is bad.
Yeah. When
you read the comment section, it's good Lord.
When all of them go bad at the same time. And again, you tally up the bear and bull and you're like, through both lenses, I look at this, you're massively off balance. I've never seen good things happen.
Yeah. And this is the kind of stuff that you would hope like a policymaker would look at this stuff and be like, man, this is getting weird. But I know they're just going to look at the 10-year and the S&P and call it good, right?
Yeah. No.
And that stuff's giving them the opposite for the last 3 weeks.
Well, and to be fair to them, right? To be fair, if you are really serious about this confrontation with China or anybody that is, had predatory economic practices or anything like that, that confrontation, it's really hard to imagine a productive confrontation, right? Not hitting economic activity to some degree.
Right. Which is why you come out on the front end, you get everyone ready for that. You get them on board with that. You build coalitions around that.
Yep. And so I don't think that, this is not, Trump said, we're going to go through some pain. Bessent has said, this can get uncomfortable,
They've backed off of those warnings lately though.
Well, yeah. Cause I think they started getting worried about losing the long end or at least that's certainly this perception I have from watching it play out. But yeah, it continues to be one of those very bizarre environments where you watch this market ignore everything except what it wants to hear. And that seemingly has very little to do with, valuations, fundamentals, balance sheets, all that kind of stuff. So, yeah, interesting path forward for sure. We got a bunch of data coming out this week. What else are we looking at?
Yeah, tons of data still, and I didn't even mention job openings from Jolts. That was below all estimates. But going back to you got to add up both sides. Like the internals of it were fine, so I didn't put a lot of weight on it because of that. So we have obviously Jobs Friday. We also have ADP jobs, the private sector one.
And I don't mean to interrupt you. Continue on your thought, but this goes back to one of your favorite deals. One of the things that I think is keeping things holding in here is the fact that the stock market isn't down further.
Oh yeah, which like it's own economic fundamental. So to a degree, it makes sense. But tomorrow we'll have ADP. We'll get the first quarter GDP print. So with that, you'll get PCE prices, personal consumption, all that kind of good stuff. We'll get the employment cost index, which is the Fed's favorite wage growth kind of indicator. Not that relevant these days, although it might get relevant again eventually. But so that's just tomorrow, and as well as pending home sales. And Thursday, we'll get job cuts, obviously jobless claims every Thursday. ISM. This is going to be to me an important ISM. And then Friday is jobs day. We'll also get on Thursday, I think, auto sales, which I'm assuming is still going to be good. And then it's going to get, then it becomes a problem. And
you mentioned something else too, and that's something you guys everybody's going to have to keep an eye out for. Like you're going to see really bad soft data, and I would expect to see some upward surprises for a lot of these companies that are benefiting. And I think automobiles is a perfect example that are benefiting from the rush to beat tariffs.
It exploded higher last month. Looked great. It's making industrial production and stuff like that look a little better. And along those lines, obviously we get that monthly retail sales print from the government, but Redbook has a retail sales print that they just update weekly that you can keep an eye on. Dallas Fed has a weekly activity index. These are good like real-time data proxies, and both have been like pretty solid lately, especially retail sales. I mean, you're talking 7.5% year over year gains in retail sales.
Yeah, that's not organic.
But you can already see it, like it's starting to downshift, and logic would dictate it's going to downshift in a significant way.
And I think here's one of the tells here, right? Like that is, I mean, that's too big of a beat.
Yeah,
You know what
exactly.
I mean? Like, I mean, guys, that's the kind of jump that you'd expect to see in retail sales coming out of the bottom of a nasty recession, not at the top where
Right.
we're at here.
And I've seen people defending the economy, like, oh yeah, but look at Redbook retail sales. Like, yeah,
Come on. That's
you know,
all.
how many people, you know, how many people are buying everything they get their hands on at Costco because they might not be able to in 3 months.
Well, not only that, but retail sales is also a nominal calculation, right? So what are people going to front run the most? They're going to front run the expensive items, right? So I mean, that's going to be it. Once again, that to me, you can't
You
put.
can just go in there like everything that I like. Is it made in China? I'll take it.
Yep.
You know?
And you're starting to see it. You're starting to see some thin shelves. You're starting to hear reports of it. So that's going to be, I think that's going to be confusing for a lot of people. And that might be getting baked into the calculus from the administration too. They might know that, look, we've got this kind of like month to 2 month stimulus of people trying to front run this. So maybe that buys us a little extra time. My point is, I don't see us getting out of this without pain. That's my whole thing. It's just very hard for me to imagine that for a whole host of reasons.
Yep.
Not to mention actual economic stuff, right? Like, meaning there's a lot of crosswinds out there, and none of them favor the valuations that we're sporting here in the U.S. So anyway, anything else you got to add today?
Nope, that's good.
All right. Well, we're certainly going to be back tomorrow. We got a lot more data coming in before the end of this week, and I think we're going to have an increasingly better picture. I wouldn't expect it to be substantially different from what we're seeing now, but we'll keep an open mind. So anyway, and if you guys, as always, or to remind you guys rather, we are now on YouTube and TikTok and Instagram and all that stuff. So go to YouTube, find the video, not just audio, video now. So, Chase and I still, I mean, if I was going to listen to Know Your Risk podcast, I would listen to it and not watch it. That's just me, but I'm biased. But yeah, Know Your Risk podcast on YouTube. And if you want to, please sign up and subscribe too, which is knowyourriskradio.com. Anyway, you guys know the drill. We'll see you tomorrow, and have a wonderful evening. You're listening to the Know Your Risk Radio podcast. Download and subscribe at knowyourriskradio.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.